Hello, my name is Eddie Tofik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of Paris milling wheat, Minneapolis wheat, and London UK feed wheat. Hello and welcome. Before we start, I just wanted to let you know that no AI, that is artificial intelligence, was ever used in the composition, production or recognition of any of the patterns, levels, analysis or any related items on these my charts. This was all my own original work, as I think you deserve to have that. So with that, Paris milling wheat. Key pattern here, unlike the American markets, continues to be purple highlighted mid-March to mid-May shallowy bearish shift pitchfork. The market right now either side of the purple middle time, which is currently at 190.25. This bearish shift pitchfork continues to be an excellent indicator of the market's overall bearishness. The most recent FN has seen prices press down through the support that stretches from March 2021 low at 191.75 down to the congestion at 187.25, making a new low not seen since September 2020. However, so far the market has still not managed to stabilize down there, enough that the overhead bearish pressure of the green short medium moving average, currently at 192.5, and probably the better bearish pressure of the declining mauve medium moving average, currently 194, will have had cap prices as well. Looking below the March 24 and September 25 lows at 187.75, the market has, as I said 12 weeks ago, and I quote, "We don't seem to have anything that significant support until the August 2020 low at 176.25 area," end of quote. Thus, we're at the end of a significant support zone, so it's not surprising to see some small hesitation here, if any, ahead of any possible jump, quite large jump, possibly lower or even higher. Yet I would ask you to consider one final thing. Last week, the market made a weekly key reversal down, if only just. I said last week, and I quote, "Be interested to see how the market deals with that factor next week," end of quote. Well, the market this week has had a reactionary session, but not too far and not too hard, so the onus is still, for the moment, on the downside. Minneapolis wheat. The market here seems to be held in the sway of two, possibly three features, and it is different in many ways from Chicago and Kansas City wheat. The first feature is the bright red May to July head and shoulders top neckline, currently at 565.25. This neckline had not acted as a cap, but more as an attractor to the market, and had been pressuring prices lower. Now, adjacent to this for some time had been the green short medium moving average, currently 576.25, which had been a bearish pressure until 4 weeks ago, when it in parts started to become a support, and in parts a more recent attractor, even perhaps considering going back to being a cap again. I said 3 weeks ago, and I quote, "Part of me can't decide if it has been the green short medium moving average or the bright red neckline that had been leaning the market lower, but I guess we will soon see, as they have now started to separate," end of quote. Well, the separation seems to have caused both to fail as immediate bearish pressures, though the green short medium moving average is trying to resurrect itself as one. Not far below now, we have the dark blue September 2019 today uptrend, currently at 567.75. This one had been realigned so many times, but it finally seems to have found its groove here. There is no real double bottom pattern here as we have seen elsewhere, but that doesn't mean we will not be immune to results of such a pattern when they occur elsewhere, so just be aware. However, there is a larger pattern which I would draw your attention to once more. I spoke about this pattern 15 weeks ago and ever since, when I said, and I quote, "We are also possibly on the threshold of a really big pattern, a December 2024 to date possible cat's ears pattern. This is a bearish pattern, but the discussion for this, which I have postponed for a couple of weeks, may be coming up and real soon, as we are about to trigger the downside opportunities for such a pattern. It's a long-term pattern, but I urge you to keep remembering this idea, as if we travel and stabilize a little lower than where we are, I may feel obliged to deploy it, along with all its ramifications," end of quote. Now, I still stand by this, And I've watched the developments around the gapping action in September and late October's and early November's moves once more towards the lows of September with great interest. Despite all this, we are still close but not quite there in triggering this pattern, and this is where two other factors may play a crucial role. The next factor is the bearish pressure of the declining mauve medium moving average, currently 581 3/4. This doesn't have pedigree in pressing the market lower, but it is still nevertheless sitting there. The last one is a little higher up, and this one does have pedigree. It's the purple July 23 to date downtrend, currently at 587 even. This downtrend impacted the market back in late June and again in early July, and capped the market back then with a head and shoulders top, so watch out. I suspect that downtrend will be key on any attempted moves higher, and most interesting of all, this purple downtrend crosses the dark blue uptrend in late January. I do not think we will have to wait till then to find out the result, but I caution you of possible false breaks before the crossover. London UK feed week. Okay, so there has been on this daily chart until early July and running for around a year now, one major significant pattern here, a pattern that we have not seen in the other grain markets, a pattern that I still have on my daily chart for a reason. The pattern is the bright red May to early July 2024 bearish shift pitch fork. In early July, due to changeover, we had a very large gapping move higher, up and out of this pattern, up beyond the now broken bright red upper tone. It's currently 157.65. Now, added to this upper tone back then, we had a higher up and important, even today, the important 50% absolute Fibonacci line at 180.5. And you had there, and even now still have, an area overhead that is a significant resistance as it capped the market on its rise back in July, with some added nearby help at the time from the purple July 23 to date downtrend, currently at 176.60. Since that peak, we've seen prices ease lower, moving eventually below all the moving averages and penetrating, but eventually not pushing back below the previously mentioned broken red upper tone, bright red upper tone. For a while, seemingly happy to slide along the top side of the bright red upper tone, but for quite a while until parting company in early November. However, what is more important here, and this is key, is that we are establishing the market longer term, establishing it below the very, very important dark blue neckline extension on my daily chart, which is currently at 168.5. A neckline to a pair of very long-term patterns, which I will shortly detail. Now, I also drew some weeks ago a bright green, late January to mid-July, quite shallow bearish shift pitch fork to hopefully show the newer bearish angle of attack. In this pattern, the market is in between the bright green upper tone above, which is currently at 176 3/4, and the bright green middle tone below, currently at 154.10. To be honest, I really don't think the pattern adds much to the conversation right now. This all leads me to my final points, the same points I've been discussing here for months now, and some of them were something that I noted back in my annual commentary back in January this year on London Feed Week. To see these, is best if we switch to my longer term monthly charts. Firstly, I saw back then the potential for a very large May 23 to date cat's ears pattern. Now, this is a bearish cat. It's akin to a double top but formed after a big fall, such as the fall we had in early 2023. As well as this, we have an even longer term second pattern, an August 2020 to date very large head and shoulders top pattern. These two super long-term patterns both rely on one single feature, and that is their common neckline, highlighted in purple on my monthly chart, currently at 168.5, the same as on the daily chart I just spoke about. Thus, from these two longer-term bearish patterns, we have a primary target X3 for the bearish cat's ears pattern will be down in the 127.5 zone, which is below the bright red and big old 2005 to date uptrend, which is currently at 132 3/4. And a secondary harder to reach target X4 will be down in the 112.85 zone, around where the shallower dark blue lower trend line is, currently at 114.40, and that's for the 2007 to 2022 ascending expanding wedge pattern. For the head and shoulders top, we would have an even longer an even lower primary target, X5, down in the 6420 zone, close to where sits the oldest uptrend I have on any of my 200 or so charts, and that's the 1975 to date. Yes, a half-century old uptrend, currently at 6610. I'm not even going to give you my secondary harder to achieve target for this pattern. It's below 0. Please bear in mind that these are very long-term chart targets, stretching possibly over many years, but there's still targets below for these patterns above. Now, that all being said, July this year we've changed over through a major spanner in the works for such longer term patterns. The reactionary immediate countering monthly key reversal up for July went back above the purple neckline, but stopped at the 50% absolute Fibonacci line at 180.5 and just under the bright green 2023 two-day upper bear channel line, which is currently at 178.20. The question this posed, and it is a longer term question, is whether this was just a reactionary single month move higher or the beginning of something else. Once again, as in my previous commentaries, I'll continue to stick to the reactionary single month move higher, as the levels for the last few months look very much the same, and despite this, do not look like they are forming a strong enough base. Not yet. But I am prepared even now to start looking at the possibility of a new base of support, should that happen. There's one caveat to this basing higher idea, and it's one I've already mentioned. It's the bright green mid-23 to date big bear channel, currently 129.45 to 178.20. Even with such a big reactionary move back up, we are still sitting within this big bear channel, and it does have the advantage of already having at least the minimum 5 touches necessary to legitimize it as a bear channel. For all this discussion, we're still dealing here with some very long-term patterns, and you should please bear that in mind. Thank you for listening and watching this broadcast. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. The copyright is Eddie Tofpick and ADM Investor Service International Limited. And here comes the final important bit.